I was doing a bit of a financial spring cleaning last weekend. I opened up my laptop, logged into all these different brokerage accounts I've collected over the years, and I had this moment of, honestly, it was horror.
Horror. That's a strong word for a brokerage statement. Usually it's just mild disappointment.
No, it was horror because I realized my portfolio looks exactly like that junk drawer everyone has in their kitchen. You know the one?
Oh, I know it well. The drawer with the dead batteries, the rubber bands, the takeout menus from 2018, and maybe a screwdriver that doesn't fit anything.
Exactly. That is my financial life. I've got a random tech stock I bought because a guy at a party mentioned it. I've got a fixed deposit my dad forced me to open when I was 22. I've got some mutual fund I clicked on by accident. It's a mess. There's no plan. It's just stuff.
Mm.
And looking at it, I realize I have no idea if this pile of stuff is actually going to get me where I need to go.
You're describing the default state of the modern investor. We collect financial products like souvenirs, but you're right to be horrified because a pile of bricks isn't a house.
Right.
And that is the perfect segue into what we are covering today. We are doing a deep dive into the NISM Series XA certification, specifically Chapter 15, the portfolio construction process.
This feels like the moment in the movie where the hero finally finds the instruction manual.
It really is. I mean, if the previous chapters were about the raw materials, equity, debt, derivatives, Chapter 15 is the architectural blueprint. It explains how to take those raw materials and build a structure that doesn't collapse the first time the wind blows.
And for everyone listening, especially if you are prepping for the NISM exam or just trying to fix your own junk drawer portfolio, our mission today is simple. We are going to replace the need for you to read the PDF.
We're going to cover everything.
We are going to cover every section, every definition, and I'm going to push for the practical reality behind the theory.
And I'm going to flag every single question that is likely to pop up on the test. There are specific numbers and definitions here that are, easy marks if you know them and painful misses if you don't.
I'm ready to learn. Let's start at the very beginning. The chapter opens with section 15.1, the importance of asset allocation. Now, asset allocation is one of those terms that gets thrown around at dinner parties to sound smart. But strictly speaking, what are we talking about?
Strictly speaking, the text defines asset allocation as the process of deciding how to distribute an investor's wealth into different asset classes. But before we gloss over that, we need to define asset class. It's not just a random grouping.
Right. It's not just things I bought on Tuesday.
No, not at all. An asset class is a collection of securities that share similar characteristics, similar attributes, and this is key, similar risk and return relationships. They tend to behave in a comparable way.
So if I own shares in Infosys and shares in TCS, those aren't two different asset classes.
Correct. Those are just two different securities within the broader equity asset class. You can even say they're in the tech sector subclass within equity. The text emphasizes that you have these broad asset classes like equity, bonds, and cash, but can also drill down into sub-asset classes.
Okay, break that down for us. What does a sub-asset class look like?
Well, take bonds. That's the broad class. But inside that, you have treasury bonds, which are government debt, so they're very safe. Then you have corporate bonds, which is company debt. And then you have, say, junk bonds, which are high-yield, high-risk bonds from less stable companies. Those are all subclasses.
And for equity?
For equity, the most common way to break it down is by company size. You have your large-cap stocks, the big established giants, then mid-cap, and finally small-cap, which are younger, often riskier companies.
Okay, so let's contextualize this for the Indian market. Let's say I have some money sitting in a fixed deposit at HDFC Bank, and I also own a Nifty 50 index fund. In the eyes of this chapter, what do I own?
Okay, good example. The fixed deposit is considered cash or cash equivalent. It's essentially risk-free. It's highly liquid. The Nifty 50 fund, on the other hand, is large-cap Indian equity. So you own two very, very different asset classes.
And the chapter starts here for a reason, I'm guessing.
It does. And this is the first major takeaway for everyone listening. That decision, the allocation between your FD and your Nifty fund, is the single most important decision you will make.
Hang on. More important than which bank I choose for the FD or which specific stock I buy?
Significantly more important. The text states clearly that professional investment experience suggests that in the long run, your asset allocation decision influences your portfolio's performance way, way more than picking individual stocks or trying to time the market.
I want to pause on that because it's so counterintuitive. I mean, we spend 90% of our time arguing about whether to buy Tata Motors or Maruti. But you're saying the text argues that's the wrong focus.
It's not that it's irrelevant, but it contributes far less to the end result than you think. Think of it this way. If you are 100% in cash, it doesn't matter how brilliant you are at picking the best savings account, you will never ever beat inflation or generate wealth like someone who is 100% in equity during a bull market.
The vehicle matters more than the lane you're in.
That's a great way to put it. Step one isn't buy Tata Motors. Step one is how much equity do I need versus how much cash? That's the foundation.
That's a Blinkist level insight right there. Okay, so we're starting with the foundation. Now, moving to section 15.2, we run into a concept that usually makes people's eyes glaze over: correlation.
It sounds like a math class nightmare, but it's actually the secret sauce of investing. Section 15.2 covers understanding correlation across asset classes.
Let's strip the math away for a second. What is it actually measuring?
It measures two things, really: strength and direction. It tells us how the price of asset A moves in relation to the price of asset B.
And there's a specific scale we need to know for the exam, right?
Yes, absolutely. The correlation coefficient ranges from -1 to +1. You need to memorize that range. It cannot be greater than 1, and it cannot be less than -1.
Okay, help me visualize this. I'm listening to this deep dive on my commute. What does a Fe +1 look like in the real world?
Okay, imagine two dancers on a stage. If they are perfectly synchronized, when one steps forward, the other steps forward. When one steps back, the other steps back. That is a correlation of +1, a perfect positive relationship. They move together lockstep.
So if my portfolio is just full of assets that are all +1 correlated, I basically just have one big asset.
Exactly. And that's incredibly dangerous, because if one of them trips, they both faceplant. There's no safety net.
All right, so what about the other end of the scale? -1.
-1 is a perfect negative relationship. So back to our dancers. When one steps forward, the other steps back. They are perfect mirror images moving in opposite directions.
And why do I want that? It sounds chaotic.
You want it because of risk. The text states that correlation is the most relevant factor in reaping the benefits of diversification. To reduce the risk of your portfolio blowing up, you want to combine assets that have low or even negative correlation.
Let's look at an Indian market example. Everyone talks about gold.
Gold is the classic example. Historically, equity and gold often have a low or even negative correlation. Think about a market crash volatility spikes. Everyone is panic selling stocks. What tends to happen to the price of gold?
It usually goes up. Or at least it holds its value while everything else is falling. It's seen as a safe haven.
Right. It's the fear trade. So if your portfolio has both equity and gold, when the equity part is tanking, the gold part is acting like a shock absorber. It cushions the fall. That is the free lunch of diversification.
And that's what keeps you in the game. You don't panic and sell everything at the bottom because your whole portfolio didn't go to zero.
Exactly. But there's a really important nuance here.
Which
is this a guarantee? Like, does gold always go up when stocks go down?
I was just about to ask that.
No, and the text is very careful to point this out. Correlations are not static. They change over time. They change in different economic regimes.
Right.
In a massive liquidity crisis, like what we saw in March 2020 at the onset of the pandemic, sometimes everything falls together because people are just selling whatever they can to get cash.
So past correlation isn't a guarantee of future correlation.
Correct. It's a guide, a very useful one,
Yeah.
but not an unbreakable law of physics.
That's a crucial distinction. It works most of the time, but not necessarily all of the time. Okay, so we know we need to allocate assets, and we know we need to mix things that don't dance in sync. Now, how do we actually build the house? Section 15.3 covers the steps in portfolio construction.
This is the workflow. The text describes it as a set of integrated activities. It's not random. It has to be logical, orderly, and consistent. And there are 5 specific steps.
Let's walk through them one by one. Step 1.
Step 1 is the development of the policy statement. This is your foundation.
Okay, step 2.
Study of financial conditions. Basically, what's happening in the world and what do we think is going to happen next? Forecasting.
And then step 3, I assume, is the actual building part.
Exactly. Construction of the portfolio. This is where you actually buy the assets.
Step 4.
Performance measurement and evaluation.
Right.
Did it work? Did we make money? Did we meet our goals?
And finally, step 5.
Periodic review. Because life changes, markets change, and your portfolio has to adapt.
I want to spend some serious time on step 1, the policy statement. The text calls this the IPS, the investment policy statement. Honestly, this sounds like boring corporate paperwork. Is it actually useful, or is it just something advisors charge a fee for?
It is the single most critical document in the entire relationship. Sections 15.3.1 through 15.3.3 are dedicated to this. The text calls it the roadmap. Without an IPS, you are driving in the dark, at night, in the rain, without GPS.
Okay, convince me. What does the text say are the actual purposes of this document? Why do I need one?
It lists 4 specific purposes. And if you're taking the exam, flag this. You will almost certainly see a question like, which of the following is not a purpose of the IPS?
All right, let's hear them. Purpose number 1.
It enables investors to have realistic return expectations.
I like that. So it stops me from walking in and saying, I want 0 risk but 25% returns.
Exactly. The IPS forces the conversation, where the advisor has to say, based on your risk tolerance, that is mathematically impossible. It grounds everyone in reality.
Okay, what's purpose number 2?
It enables effective investment decisions that are actually aligned with your objectives. It acts as a filter. So if the IPS says we are long-term growth investors, we automatically ignore the noise about a hot tip on a penny stock. It doesn't fit the plan.
Right. Purpose number 3.
It provides a framework for evaluating the portfolio manager.
This is the report card.
It's the report card. You can't just say you did a bad job.
Yeah.
You have to measure the job against the instructions you gave. Did the manager follow the roadmap we agreed on? And that leads to purpose number 4, which is fascinating. It protects the investor.
It protects them how? From what?
It protects the investor against unethical behavior or inappropriate decisions by the manager. Think about it. The IPS is essentially a contract. If it says no more than 60% in equity, and the manager puts 90% in equity and loses your money.
You have a clear case.
You have a very clear case. You can point to the document and say, you violated our agreement.
So it's a legal shield in a way.
In many ways, yes. But for it to work, and the text emphasizes this, the investor has to be brutally honest. You have to be upfront about your entire financial situation. If you have a secret loan you didn't tell your advisor about, or if you say you're brave but you actually panic when the market drops 2%, the IPS will be built on a flawed foundation.
Garbage in, garbage out.
Precisely.
Okay, so we're drafting this IPS. What are the core components that go into it? Section 15.4 talks about investment objectives.
Right. The objectives usually revolve around what I call the holy trinity of finance: risk, return, and liquidity.
We all know risk and return go hand in hand. If you want higher potential returns, you have to take higher risks. But where does liquidity fit into that picture?
Liquidity is the ability to convert an asset into cash quickly without losing significant value. The text notes that liquidity generally has an inverse relationship with return. This is often called the illiquidity premium.
Can you give us a real-world example of that premium? That feels a little abstract.
Sure. Compare a simple savings account to a piece of real estate. A savings account is maximum liquidity. You can walk to an ATM and get your money in 30 seconds. Because it's so convenient and accessible, the bank pays you very little interest. So low return.
Makes sense.
Now look at a plot of land. To sell that land, it might take 6 months, maybe longer. You have to find a buyer, negotiate, do all the paperwork. It is highly illiquid. Because you are locking your money away and accepting that inconvenience, you expect a significantly higher return. That extra return is the premium you get for giving up liquidity.
That makes perfect sense. So in the IPS, we generally classify our objectives into 3 buckets, right?
Yes. The text lays out 3 primary ones. First, you have capital appreciation. This is all about growing the pot of money. It's high risk, high potential return. Think equity funds.
Okay, what's number 2?
Second is capital preservation. This is the do no harm objective. Safety first. This is for money you absolutely cannot afford to lose. Think bank FDs or government bonds.
And the third one?
Regular income. This is for when you need the portfolio to generate cash flow for you to live on, maybe in retirement. Think dividend-paying stocks, rate-yielding property, or a bond ladder.
So I decide I want, say, capital appreciation. But I can't just do whatever I want. There are limits. Section 15.5 introduces investment constraints.
Constraints are the reality check. They are the guardrails. They limit your ability to take exposure to certain opportunities, even if they align with your objectives. The text breaks these down into liquidity, regulatory, and tax constraints.
Let's dig into liquidity constraints, which is section 15.5.1. We just talked about liquidity as an objective, but here it's a constraint. This is about needing cash, isn't it?
Correct. And this varies heavily by your stage of life. A 25-year-old usually has low liquidity needs because they have a salary and relatively low expenses. A 70-year-old retiree has very high liquidity needs because they are living off that pile of money. The text categorizes these needs into 3 specific types.
I want to get the specific numbers here. What's the first type of liquidity need?
The first is emergency cash. This is your absolute safety net for unexpected life events.
Okay, and this is a big one. Exam flag alert, I'm guessing.
You're right. The text specifically says emergency cash is usually measured at 2 to 3 months of spending.
2 to 3 months, is that enough? I've heard people say 6 months or even a year.
Well, the text adds a very important caveat. It could be more if the individual's income is volatile. So if you're a freelancer or a business owner with lumpy income, yes, you might need 6 months. But for the exam, the answer they are looking for is 2 to 3 months.
Got it. Memorize the textbook answer. What's the second type of need?
Near-term goals. These are known planned expenses coming up within, say, a year. A tuition payment, a down payment for a car, a big insurance premium.
And the rule for that money?
The rule is strict. Assets earmarked for these goals must be in relatively liquid and very low-risk instruments. You do not put next year's college fees into Bitcoin.
Or even into the stock market, just too volatile in the short term.
Exactly. And the third type is investment flexibility. This is what some people call having dry powder cash on hand to take advantage of market opportunities. If a market crashes 20%, you want some cash available to buy assets when they're on sale.
Okay, that covers liquidity. Moving to regulatory constraints, section 15.5.2. This is where the law comes in.
Yes, and there's a massive exam question hiding in this section. It discusses the RBI's Liberalized Remittance Scheme, or LRS.
This is the rule about sending money out of India for investment, right?
Correct. The text specifically mentions the Reserve Bank of India's notification on this. An Indian resident individual can only remit, which means invest or spend overseas, up to a specific limit per financial year.
And that magic number is?
$250,000 US.
$250,000. Flag that.
Absolutely. Flag it, highlight it, memorize it. Whether you are buying Apple stock in New York or a condo in London, that is your annual cap as an individual. The text also mentions insider trading here as another regulatory constraint.
Right, the classic example. If your cousin at a pharma company tells you the drug trial failed before it's announced, you cannot legally sell your shares on that information.
Exactly. That's a regulatory constraint on your actions.
Finally, let's talk about tax constraints. 15.5.3. How much does the taxman actually influence portfolio construction?
Enormously. I mean, it's not just about what you earn, it's about what you keep. Different types of investment returns are taxed very differently in India. Interest from a bond or an FD is usually taxed as income from other sources.
Which means it's just added to your salary and taxed at your personal slab rate.
Right, which could be 30% or even higher. But long-term capital gains on equity, for example, might be taxed at 10 or 12.5%, depending on the current budget rules.
That's a huge difference.
It's a massive difference. So imagine you are a high net worth individual in the top tax bracket. You might actively prefer growth assets like equity simply because they are more tax efficient for you than income assets like bonds. The IPS has to account for this. The goal is to maximize post-tax returns, not just pre-tax returns.
That's a really practical takeaway. Don't ignore the post-tax return. Okay, let's move to section 15.6 and 15.7. We have exposure limits and something called unique needs.
Exposure limits are about putting safety rails on the portfolio. This section references the SEBI PMS regulations of 2020. The core idea is to prevent concentration risk.
So putting all your eggs in one basket.
Precisely. Your IPS should explicitly state things like no more than 10% of the portfolio in any single stock, or no more than 25% in the entire banking sector. It stops the manager from getting carried away and betting the farm on one horse.
And then section 15.7 covers unique needs. This sounds more personal.
It is. This is where the client's personality and values come into the picture. The text breaks it down into sustainable investing and ethical investing.
Are they the same thing? People seem to use them interchangeably.
They are cousins, but they are different. Sustainable investing, which is 15.7.1, is largely about ESG. That's environmental, social, and governance factors.
You're right.
The text mentions looking at things like a company's pollution control, the E, its board diversity or labor practices, the S, and its executive pay or shareholder rights, the G. The belief here is that companies who are good at ESG will actually perform better financially in the long run. They're seen as being better managed and less risky.
So it's kind of a do good to do well philosophy.
Yes, that's a good way to phrase it. Ethical investing, covered in 15.7.2, is often defined by what you don't buy. It traditionally uses what's called negative screening.
This is the moral filter.
Exactly. An ethical investor might come to you and say, my religion or my personal code forbids me from profiting from alcohol, tobacco, gambling, or weapons. They refuse to own these sin stocks. regardless of how much money those stocks are making. It's a values-based decision, first and foremost, not necessarily a performance-based one.
Okay, we've built the constraints and accounted for personal values. Now we need to look at the investor's actual life goals. Section 15.8 provides a pro forma for creating a goal sheet.
This is a simple but incredibly powerful table that every investor should fill out. It just has 4 columns: goal name, priority, time period, and amount needed. The key insight here is how the text tells us to prioritize and fund these goals.
How so?
It creates a hierarchy. First, you have near-term high-priority goals.
Like a down payment for a house you want to buy next year.
Exactly. The text says the cost of failure for these goals is too high. You absolutely cannot risk this money. It must be in cash equivalents or short-term fixed income. Full stop.
What about the big ones further out?
Then you have long-term high-priority goals, with retirement being the classic example. Because you have a long time horizon, you can and should take more risk. You can use a diversified portfolio with a healthy allocation to equity.
And then the fun stuff.
Right. Low-priority goals, buying a luxury car, a vacation home, that sort of thing.
Yeah.
The text says for these, you can use more aggressive investment approaches. If the aggressive bet pays off, you get the Ferrari. If it fails,
You drive the Honda, your life isn't ruined.
your life isn't ruined. I love that distinction. Risk the luxury, but you must secure the necessity.
Okay, we've covered the what, now for the who. Section 15.9 talks about assessing the investor's financial position, which seems straightforward. Net worth and cash flow.
Yes, it's the basic accounting. Net worth is simply your assets house, stocks, gold minus your liabilities like a home loan or a car loan. And cash flow is your income minus your expenditure. You need these numbers to know what you're working with.
But then we get into the really interesting part. Section 15.0, psychographic analysis. This is behavioral finance, right?
This is my favorite part of the chapter because it acknowledges that investors are human, not robots. I mean, standard finance theory assumes we are all perfectly rational economic machines. Behavioral finance knows that we are often, well, a little crazy.
I can relate.
And the text introduces a fantastic framework for this. The BB&K model, which stands for Baylard, Beal, and Kaiser.
Listeners, I want you to visualize a chart right now. Imagine a big plus sign, 2 axes crossing each other.
That's the perfect way to picture it. The vertical axis measures confidence. At the bottom, you have anxious. At the top, you have confident.
Okay. Anxious to confident.
And the horizontal axis measures your method of action. On the far left, you have careful. And on the far right, you have impetuous.
Impetuous means impulsive, right?
Right.
Acting without thinking it through.
Yes, exactly. Now, these 2 axes create 4 quadrants and a center point, 5 distinct investor personalities, and you absolutely need to know these for the exam.
All right, let's tour the map. Where do we start?
So let's start in the top right corner. This is someone who is both confident and impetuous. The model calls this person the adventurer.
Who is this person? What do they do?
This is the gunslinger. They make concentrated bets. They'll go all in on a single idea. The text notes they are often difficult for advisors to manage because they have their own strong opinions and they actively seek out risk. They think they know better than the market.
I know a few of those. Okay, let's move down to the bottom right quadrant. Anxious and impetuous.
That is the celebrity.
The celebrity.
Not a literal movie star, but someone who wants to be where the action is. They suffer from a massive case of FOMO, fear of missing out. They're the ones who call you and ask, everyone is buying crypto. Should I be in that?
They follow the herd.
They follow the herd impulsively. They don't really understand the investment. They just don't want to be left behind. The text actually says they are the most difficult type to manage because their beliefs are confused and shift with the latest trend.
I think we all know a celebrity investor, or have been one at some point. Okay, let's move to the left side of the chart. Top left. Confident and careful.
That is the individualist. These investors are rational. They do their own research. They're often contrarian. They are comfortable buying when everyone else is selling. They'll listen to an advisor, but they make the final call based on their own logic and analysis.
They're methodical.
Very.
Okay.
And finally, the bottom left. Anxious and careful. That is the guardian. These are often older people or those approaching retirement. They are terrified of losing money. For them, wealth preservation is the only thing that matters. They lose sleep over market volatility.
And that leaves the person right in the middle, at the center of the cross.
That's the straight arrow. The balanced, normal investor who is willing to take a medium amount of risk to achieve their goals. They're sort of the ideal client in the middle of all these extremes.
So why does this matter? Can't I just give everyone the same balanced portfolio?
Absolutely not. And this is the whole point of the model. If you give a volatile, high-growth, adventurer-style portfolio to a guardian, they will panic and sell everything at the first 10% dip. You have to match the portfolio to the personality, not just the financial goals.
The psychology is as important as the math.
It might be more important.
Fascinating.
Ah.
Okay, moving on from psychology to demographics, section 15.11, life cycle analysis.
Right. This is another way of looking at the investor, this time through the lens of age. If you chart net worth against age, it typically forms a hump-shaped curve. The text breaks this down into 4 phases.
What's the first one?
Phase 1 is the accumulation phase. This is you in your early career. You have low net worth, maybe even negative if you have student loans, but you have a very long time horizon. Your biggest asset is time. So you can and should take high risks.
Okay, what's next?
Phase 2 is the consolidation phase. This is your mid to late career. Your income probably exceeds your expenses. These are your peak earning years. The challenge here is balancing continued capital growth with an increasing need for preservation as retirement gets closer.
And then retirement itself.
That's phase 3, the spending phase, or as the text calls it, the decumulation phase. You stop earning a wage and start living off your assets.
And the text mentions a very specific risk for people in this phase.
Yes, and it's a big one. Inflation protection. Even though you are retired and your goal is preservation, you cannot just put everything in a bank account. You might live for another 20 or 30 years. You still need some growth in your portfolio to ensure your purchasing power doesn't get eroded by inflation.
You have to make sure your money lasts as long as you do.
Exactly. And the final phase. Phase 4 is the gifting phase. This is for the lucky few who have more assets than they'll ever need. The focus here shifts to estate planning, charity, and leaving a legacy.
We are in the home stretch of the planning process now. Sections 15.12 and 15.13 touch on forecasting and benchmarking.
Right. Forecasting is about taking all the inputs, the investor's needs, the life cycle, the psychology, and combining them with forecasts about the capital markets. What do we think interest rates will do? What about corporate earnings? The key here is that historical data is a starting point, not the final word.
And benchmarking.
Benchmarking is crucial for that evaluation step we talked about earlier. The text emphasizes the importance of an apple-to-apple comparison.
Give me the classic bad example.
The classic bad example is someone with a conservative bond portfolio comparing their returns to the Nifty 50 during a raging bull market. The bond fund will look terrible, but that's a completely false and useless comparison. You must measure your portfolio against a relevant standard.
So if you have a large cap Indian equity portfolio,
You benchmark it against the BSE 30 or the Nifty Y50. If you have a bond fund, you benchmark it against a bond index. It seems obvious, but people get it wrong all the time.
now, section 15.14 and 15.15 bring it all together with the asset allocation decision and some construction principles.
Yes, this is the culmination. You take all the information about the investor and all the information about the market, and you make the big decision. The goal is to optimize for after-tax returns that meet the investor's specific risk, return, and liquidity profile.
And the principles are fairly intuitive.
They are. Use equity for capital appreciation. Use debt and match its maturity to your time horizon for stability and income. Use hybrid funds for a balance. And use other assets, like gold, for diversification and as a hedge.
Okay, now for a heavyweight concept in section 15.1, strategic versus tactical asset allocation. SAA versus TAA.
This is a really important distinction. I like to say this is the difference between your marriage and a weekend fling.
Okay, I'm listening.
Strategic asset allocation, or SAA, is the long-term commitment. It's the target asset mix that is defined in your IPS. It is your permanent policy portfolio designed to meet your long-term goals. It's your financial home address.
So that's the marriage. What's the fling?
The fling is tactical asset allocation, or TAA. This involves making short-term, deliberate deviations from your SAA to take advantage of what you perceive as market opportunities.
Why would we deviate from the master plan?
Let's say your SAA says you should be 50% in equity, but the market crashes and stocks suddenly become incredibly cheap and undervalued in your view. You might make a tactical decision to temporarily shift to 55% equity to capture the expected rebound. That extra 5% shift is your TAA. It's essentially timing the market in a controlled way.
But does this kind of thing even work? Or is it just gambling?
That's the million-dollar question. And the text cites a legendary study here that everyone preparing for the exam must know. It's by Brinson, Hood, and Biebauer from 1986.
Okay, exam flag on this one.
A huge one. They studied the performance of large pension funds and came to a stunning conclusion. They found that asset allocation, the strategic decision, explains roughly 90% of the variation in a portfolio's returns over time.
90%. 90.
Yes. That means all the stock picking, all the market timing, all the talking heads on CNBC, all that active management only accounts for about 10% of the result. The boring strategic decision of how much in stocks versus bonds does 90% of the heavy lifting.
That is just humbling. It basically says we are wasting most of our time looking for the next multi-bagger if our core allocation is wrong.
Precisely. The architecture is more important than the furniture.
Wow. Okay, finally, we get to section 15.20, rebalancing of portfolio. If we set this perfect strategic allocation, why do we ever need to touch it?
Because of market drift. Imagine you start with a perfect 50-50 split between stocks and bonds. Then a massive bull market happens. Your stocks double in value, but your bonds stay flat. A year later, you look at your portfolio. Is it still 50-50?
No, the stock portion is way bigger now. It's probably more like 66% stocks and 33% bonds.
Exactly. You've drifted. You are now taking way more risk than you originally signed up for in your IPS. If the market turns and crashes, you will get crushed much harder than you expected.
So rebalancing
is the discipline of periodically bringing the portfolio back to its original strategic targets. In that example, it would mean selling some of your winning stocks, selling high, and using the money to buy more bonds, buying low, to get back to that 50-50 split.
It forces you to be contrarian, to sell what's popular and buy what's not.
It does, but it's not free, and the text is clear about this.
What are the costs?
There are two main ones. One, transaction costs, brokerage fees, impact costs, etc., and two, tax costs. Selling your winners almost always triggers a capital gains tax liability. So there's a trade-off between maintaining your risk profile and minimizing costs.
And I imagine it's easier for some assets than others.
Oh, absolutely. The text mentions illiquidity. It's easy to rebalance a portfolio of listed stocks and bonds. Try rebalancing a portfolio that includes real estate or private equity. You can't just sell 10% of an apartment.
A very good point. We have covered a massive amount of ground, from the basic definition of asset allocation all the way through the LRS limits, the BB&K personalities, and the critical Brinson study.
We really have. We've gone through the entire architectural process from blueprint to maintenance. We've built the house.
So for the listener who started this deep dive with us, staring at their own junk drawer portfolio, what is the one big takeaway to end on?
Stop looking for the magic stock. Stop trying to time the market perfectly. Real sustainable success is about the architecture. Do the work up front. Write down an IPS, even if it's just for yourself. Understand your own risk profile. Are you a guardian or an adventurer? Set your strategic asset allocation.
And then?
And then have the discipline to stick to it. Rebalance when you need to, but don't blow up the plan because of the daily news.
That sounds like very boring advice.
It is. But excitement in investing usually costs you money. Boring, disciplined processes build wealth.
Excitement in investing usually costs you money. I think I'm going to print that out and tape it to my monitor. Thank you for guiding us through the blueprint.
It's my pleasure.
And to our listeners, take a moment to visualize where you sit on that BB&K axis. Remember the $250,000 limit for the exam, and good luck with your studies.